Have you ever looked at the companies that are literally building our future and wished you could own a piece of the action? We're talking about the private market giants, the unicorns, already worth billions long before they ever hit the stock market. Well, today, we're going to talk about a technology called tokenization that might just be the key to unlocking that door for everyone.
I mean, just take a second and imagine it. Owning a small slice of SpaceX as it reaches for Mars, or OpenAI as it redefines intelligence. These aren't just companies anymore. They're shaping history. For decades, getting in on this kind of action was a game reserved for venture capitalists and the super rich. But that might all be about to change.
All right, so how do we get from here to there? Here's our roadmap. First, we'll talk about the incredible promise here. Then we'll get into the tech, the digital key that makes it possible. We'll look at the two main ways you can get involved today, run through the all-important regulatory gauntlet, and finally, we'll weigh the big risks against that incredible future.
So let's start with the big idea. What is the promise, really? At its heart, it's about one thing: access. It's about cracking open one of the most exclusive investment clubs in the world, the private markets, and letting everyday people get a chance to share in the growth of these massive companies.
Okay, so what's the piece of tech that could make all of this a reality? Well, the engine driving this whole revolution is a concept called tokenization.
So what on earth is tokenization? Honestly, it's simpler than it sounds. Think of it like this. You take a real-world asset, like a share certificate that says you own part of a company, and you create a secure digital version of it. This little digital token lives on a blockchain, and it acts as your proof of ownership. It's like a digital deed for your investment. And this is where it gets really exciting. In theory, this opens up a whole new world. Transactions could be way faster and cheaper. You could own a tiny fraction of one expensive share. We could see marketplaces that never close. And, most importantly, the minimum investment could drop dramatically, making it possible for you to buy just a small slice of a very big, very private company. Okay, so that's the dream. But what's the reality on the ground right now? Well, there are already two main paths for investors to get some exposure. Yeah, this isn't just some far-off idea. It's actually happening.
So on one side, you have these secondary share platforms, like Forge or EquityZen. They're basically marketplaces where early employees and investors can sell their private shares. Now here's the catch. This is usually only for accredited investors, which is a fancy way of saying people with a really high income or net worth. But then you have the other path, tokenized funds on platforms like SoFi or Republic. These bundle together pieces of different private companies, which means regular retail investors can buy in with much, much less money.
And this is a really crucial point. For most of us, access doesn't mean you're buying a direct share of SpaceX like an early venture capitalist. What you're really buying is a piece of a fund that owns those shares. It's an indirect way in. So you own a piece of the pie, not the whole recipe, if that makes sense.
Now, this technology doesn't exist in a bubble. The single biggest, most important piece of this whole puzzle is regulation. Because when it comes to money and investing, the rules are everything.
And this is maybe the key takeaway from our whole chat today. A token that represents a company's share isn't some magical, unregulated crypto coin. Nope. The SEC in the US looks at it and says, that's a security. It doesn't matter if it's on paper or on a blockchain, the same rules apply. This isn't the Wild West.
So to offer these tokens to the public legally, companies have to play by the rules. And that usually means taking one of three paths. You can go through a full, complicated registration with the SEC. You can use a specific legal loophole, like something called Regulation A, or, and this is the most common one for retail, you package the assets into a fund that's already legally compliant.
Okay, I know this all sounds incredibly cool, and it is. But we have to pump the brakes for a second and talk about the very real risks, because this is absolutely not a get-rich-quick, risk-free kind of thing. First up, liquidity risk. In simple terms, it might be really hard to find someone to buy your token when you want to sell. Then there's legal risk. You have to read the fine print. Does your token even give you voting rights? Third, counterparty risk. Who's the trusted party actually holding the real share your token represents? Fourth, valuation risk. Private company values are not public and they can swing like crazy. And finally, regulatory risk. The rules are new, and they could change on a dime.
So where does all this leave us? Well, the future probably isn't some crypto free-for-all. It's much more likely to be a slow and steady expansion of access through channels that are heavily regulated and trusted. Think more SEC-approved funds and platforms, all built to give us a secure, even if it's indirect, way to invest. The two keywords here are going to be regulation and trust. Which brings us to the big final question.
we're really standing at a crossroads here. Is tokenization going to be the thing that truly democratizes wealth and gives everyone a fair shot at owning a piece of the future? Or is it just going to create a complicated and risky new playground for retail investors? Right now, the answer is still being written.